Welcome to The Truth About Real Estate. I'm Erin Blaise. On previous shows, we talked about buying a home with no money down with the Nehemiah program. That program has been phased out, so today we're going to talk about current loan programs, and we're also going to talk about how first-time home buyers can get a tax credit of up to $7,500 when they buy a home. Today, my guests are Bonnie Trickey from Resource Home Loans and Steve Shiery, a CPA. Let's start with you. Tell us about the $7,500 you can get for the government to buy a house.
Okay, the $7,500 new home buyer credit is one of the pieces of a huge Housing Rescue Act bill in 2008. It's 600 pages. That's more than a ream of paper. It's going to cost $300 billion. That's with a big B. That's 416 days of the Iraq War cost, or $500 million per page. But the $7,500 home buyer credit, you have to be a first-time home buyer. You can't have owned a home in the last 3 years. To get the full credit, you have to buy a home that costs at least $75,000 because the credit is 10% of the purchase price, limited to $7,500. And you have to qualify for the loan. And you also have to have an income that meets the maximum. The maximum for the full credit is $75,000 for single people and $150,000 for married people. And it kind of phases out up to about $95,000 for single. A house between April 8th of 2008, this year, and July of 09. So you've got a little over a year. You got 10 months left. Problem is the tax credit comes with the tax return you're going to file April 15th, 2009. You can't really use it for a down payment. And the tax credit has to be paid back at $500 a year for 15 years. If you sell the house, it's all due. And then there are special rules for divorce, death, loss on the sale of the home, and conversion into a vacation home.
Well, that's very interesting. So it's not just a matter of you can't just go to closing and get the money.
No.
Okay.
No, not unless they change the rules. And there are all sorts of things that happen when Congress is back in session. But right now, you can't get it until you file that income tax return.
Okay, all right. So you have to be a first-time buyer, and so that would be someone that hasn't owned a home in the last 3 years.
Correct.
And if you're married, both of you would have had to be first-time home buyers.
Yes.
Okay. And you get a credit for it on your taxes, but you don't get the credit then until you file the taxes.
That's correct.
All right. If the credit is more than you owe, then do you know if you get a refund?
Yes. It's
okay.
a refundable credit.
All right. Well, that's interesting because probably quite a few low-income people wouldn't be paying $7,500 in taxes anyway.
That's right also. But they have to qualify for the loan as well.
Right.
And without the $7,500, they have to have a real down payment.
I see. Okay.
Which gets into another aspect, talking about the Nehemiah program going away.
Right.
The Nehemiah program and the AmeriDream program are the two big players. They are prohibited from providing seller money to buyers by this same act. Okay. There's a bill been introduced in Congress to change that and let them continue. So that the life of the Nehemiah program and the AmeriDream program depend on what happens with that bill.
That's very interesting because I know that the programs, as far as realtors go, we can't close any past September 30th, and this is September 9th, so we only have 3 weeks to get these closed before they're phased out.
There may be some wiggle room on that, and that is if the loan approval is made before September 30, you may be able to go ahead and close. But you're taking a chance on that because regulations haven't been published.
Mm-hmm. So what about the bill? When will we hear something about the bill that's been introduced to extend it?
Well, it'll happen when it happens.
Oh, okay. So
You
there's no set time frame.
No, and AmeriDream and Nehemiah program are not for profits, so they probably don't have the big money for lobbying. So it may take a while. It may happen right away. It may not happen at all. It's not something that buyers should count on.
Okay, all right. So I guess a lot of people will count on putting down the 3% down payment required by FHA.
They will be required to do that, yes.
Okay, all right. Well, that brings up Bonnie. Bonnie, there's been a lot of changes in mortgage programs and what's available and the guidelines that have to be followed. Could you give us an update on what programs are still available?
Certainly. There are actually, you wouldn't know it by listening to the press sometimes, but there's lots of programs available, and it's fairly easy to get a home loan still. But you do have to have income, and you do have to have at least some good credit. There are 97% loans available in the conventional financing market, which requires just a 3% down payment. And you do have to have good credit. It doesn't have to be perfect, but it does have to at least be good to get into a home with just 3% down. There is private mortgage insurance on those particular loans, which means that the lender is insured by a third party that you pay within your payment in case you default on the loan. So then there's 5% down, 10% down. So the down payments have not changed drastically. There are just no longer an 80-20 loan. What has changed a lot is the underwriting guidelines regarding last year, you could practically, if you could walk, you could get a home loan. You walk in, you just tell people what you make, you tell them how much money you've got in the bank. It did not have to be verified. Well, that's part of what's caused this mess we're in right now, because people were misrepresenting their assets, probably with the help sometimes of the originator of that loan. So that has led to the default, which has led to the loss of property value, so it's kind of backfired on everybody. So now they're going back to really just the basics. You know, they say the basics really always work best. You have to have good credit. It doesn't have to be perfect, but at least has to be good. Everything you have done cannot be a charge-off and a write-off and get a home loan, even with an FHA loan. Now, conventional is a little more stringent on credit. They require a minimum of a 620 credit score now. But with FHA, you can get in with a 580 credit score. And for those of you who are wondering what a credit score is, they run from 350 to 850. And an average credit score is probably 680 to 700. However, there is more pricing. They have increased the rate on anybody who has a credit score under 720, and 720 used to be considered an excellent credit score. Now you need higher than 720 to be considered excellent. 680 to 720 is considered good, and then they increase pricing a little bit more as your credit score goes down, because they are pricing that risk. Okay. On the underwriting guidelines, you have to document and show your income now. You have to be able to show your assets, and it's no longer just something that you can fill out an application and that's all that you do. But that is probably a good thing, because we need to get this situation turned around, and if we continue having these losses, we will not get it turned around. Another thing that I think is probably foremost on everybody's mind has come up since Erin asked me to talk about this, and that is the government stepping in and taking control of Fannie Mae and Freddie Mac. And they have put them into a conservatorship, just like they do a bank that gets weak on capital. Fannie Mae and Freddie Mac provide about 70% of the loans in this country. So We do not want to lose the ability to provide those loans, and it was getting harder and harder for them to come up with the capital to do that, because the shorter they got on capital, the more bad loans there were, the less people that were going to invest in them. So therefore, there was a lot of pulling out of the capital for people who had invested, and new investors weren't coming in very strong, which meant they were going to have a hard time continually funding loans. This has kept rates artificially high. Now, artificially high has not been a high rate. It's been a 30-year fixed is average 6.5 to 6.75, which is really a very good rate. But considering that prime's 5% and the discount rate has been, they dropped it, gosh, several times this past year, and interest rates never went down with it. And that was because of that lack of capital. Interest rates on home loans did not go down when other borrowing did. So now that the government has stepped in, that is really going to help the market. Our interest rates dropped 0.5% already, and since yesterday. Now, will that drop stay? I have no idea. They may drop further, or they may go back up tomorrow. So everything in this day of communication depends on how the market perceives what's happening. Doesn't even necessarily mean what's happening. It's how it's perceived by the stockholders and the market, and how it reacts to every piece of news. And that can fool everybody. But it looks like rates are going to be better, and that should really generate more home buying, which will help and it will let people refinance that are in some higher rate loans, and maybe stop some of this foreclosure mess. Now, certainly if people are 4 months behind, they're going to find it hard to refinance. But if you're just struggling to make your payment, you've been on an ARM and it's gone up, maybe you can refinance into a fixed rate and get that payment a little more manageable. So that's kind of what they're hoping will happen there. The regulators are also trying to prevent a failure of banks, because many banks are invested heavily in Fannie Mae and Freddie Mac. And if those investments go to zero, then those banks are going to be in trouble capital-wise, so it could have a whole snowball effect. So that's why we really needed the government in. Now that that's happened, that's a positive thing for home buyers and home owners. What they've done with Fannie and Freddie actually is like a Chapter 11 bankruptcy almost for an individual, where they're honoring their debts, but they're put on a budget. The board and the CEOs are out and will be replaced with new board and CEO selected by the Federal Housing Authority. So that's pretty much the update on that. That should do a lot to add some more liquidity into the home buying market, which the rules have gotten a lot stricter, and a lot of that is because of the liquidity. So they will ease up on a lot of those rules if they have more capital to put into the home buying process. Then talking about different home loans, there's also a USDA government, a rural housing development, it's also known as, home loan, and it's 100% financing, and there is no private mortgage insurance on it. It's like a veterans loan. There's VA loans, and there's no private mortgage insurance. Both USDA and veterans loan have a fee that is paid to either the Veterans Association if it's a VA loan, or the USDA rural housing development. And then they don't have to pay private mortgage insurance, so the payment is much less. The houses must be in the county, and it does have income limits, but they're not extremely stringent. An example would be a family of 4 could make $74,200, and still get into a $230,000 house if they didn't have a lot of other debt. They would still be able to afford that payment, 100% financing, and it's not a huge salary. So those are very viable loans for customers right now. We talked a little bit about the Nehemiah and the Meridream program. One of the reasons that they wrote it into this bill to go away is that's where all the losses were for FHA. Nearly all of the losses were in the 100% financing. So that is made 100% financing a little harder to come by. You know, you can get in a $100,000 loan, FHA. Actually, there is one program that's 97.75% of the purchase price. So for a $100,000 loan on that program, you would have to have $2,250 down. Or for a $200,000 home, $4,500 down. You can ask the seller to pay all of the closing costs. So you can still get in for a relatively small down payment. And FHA is more lax on credit requirements also. They are not as strict as conventional. As I had said before, your credit score can be down to 580, where on conventional it has to be at least 620. But the bottom line is an average person can get a loan just like they always could. There is no, the market has not gotten so tight. What has gotten tight is the bad credit or the people who don't have the income to afford the house, but probably we needed that correction. Mm-hmm. So this has just been a correction. We liked it the other way when it was going on, but.
Yeah, we did.
So, and that's just in a nutshell kind of what's going on out there. You can still get a home loan. The average person has absolutely no problem getting a home loan. And I think there are people out there that are really afraid that they can't buy a house right now. Mm-hmm. Because I had somebody come in with perfect credit yesterday, putting $50,000 down, and they said, "Do you think it'll go? Do you think it'll be okay?" And I said, "Oh, for goodness sakes," you know. Mm-hmm. And that's a little bit that perception thing. People are almost afraid to try. They think, well, I probably can't get a loan. Average person, average credit. There's going to be no problem getting a home loan.
All right, great. Well, that's good to know. I wanted to ask you again about, I wanted to ask your opinion. Bonnie gave us some good information about the takeover of Fannie Mae and Freddie Mac, but from the point of view of a CPA, do you have any theories about what else is going to happen after this, you know, now that this has happened?
Well, it's that change is an addition to the Housing Rescue Act. It's a separate administrative change, and it's primarily to prevent them from having a run on the banks sort of scenario. Mm-hmm. You know, basically it should make investors more comfortable buying the Fannie Mae and Freddie Mac stock. It should make lenders and repackagers happier to buy loans from Fannie Mae and Freddie Mac because servicing is going to be there. So it should make the market a little better. Accounting and tax-wise, probably not much impact for the normal person out in the real world.
Well, that's good to know. I was worried that we were going to have to pay a lot more taxes to do this.
Well, you know, that the rescue bill is $300 billion.
$300 billion, huh?
$300 billion, and the bill did contain an $800 billion increase in the national debt limit. So you got to wonder where the other $500 billion goes, but probably better not to think about it. Mm-hmm. And there's also a refinance program in the housing rescue bill that's going to be pretty big. Is that the FHA Secure, or is that something different? No, that is for existing troubled borrowers. Mm-hmm. The Congressional Budget Office expects 325,000 homeowners can benefit, and the bill allows for up to 2 million homeowners. The cost is estimated at $86 billion. Borrowers have to live in the home and have loans that were issued between January 2005 and June 2007, which is, that's gone. You can't get a loan today and expect to get rescued. You have to be in the house. They must be spending at least 31% of their gross income on mortgage debt. They can either be current or in default. They have to prove they can't keep up with the existing payments, and they cannot have any home equity loans or lines of credit secured by the home. So that has to be cleaned up. They cannot take out another home equity loan for 5 years unless they need it to pay for upkeep on the house. FHA has to approve it. The debt cannot exceed 95% of the house's value. And the existing lender has to write down the loan amount to 90%. And they have to pay a fee to FHA of 3%. And they have to write off any unpaid fees and penalties. So the lender has a chance to reassess the loan and decide whether to foreclose, whether to work with the borrower, or whether to try to work it out with the refinance program.
I see. So I guess the benefit then to, considering the lender has to write down some of their fees and lose some money, the benefit is they don't have to foreclose.
Yes, and it may be that they take a smaller write-down with this program than they would if they repossess, rehab, and resell the home.
Right.
Because that's always, it's expensive and it's clumsy. Banks aren't in the real estate business. They're in the lending business.
Yes, I think the average loss is $40,000 per home they foreclose on.
It sounds like a good estimate.
Yeah. Well,
But
that's interesting. I don't think very many people know about that.
Well, it's a big part of the bill. 325,000 homeowners. That's a lot of people. That's probably more people than are going to get the new home buyer credit.
That's a lot more people, yeah.
Yeah. And it affects a lot of lenders. And there's some downsides for the borrower. A borrower who has debt forgiven, that's taxable income. And the only way to escape it is they have to prove that they're destitute. And of course, if they're destitute, they're probably not going to get a new loan. So they're going to have a tax problem. And then, if they resell the home that they've got refinanced and rescued by FHA, they have an equity sharing agreement with the Federal Housing Administration. Within a year, FHA gets all the appreciation. After a year, that sharing decreases 10% a year, but it never goes below 50% of the appreciation. So you get rescued, but it costs you.
Wow. That's very interesting. All right. I don't know if I'd want to do that. Maybe I'd want to rescue myself, go take a second job.
The borrower has a set of options to evaluate too. Do I take this? Do I let the house go? Do I continue to try to sell it? And if I come out with less money than I owe, do I try to work with the bank? Do I try to refinance that? Everybody has to evaluate the situation they're in.
Yeah, I guess so. Well, we have a program. We have a city program where if you get a grant every year that you live in the house, it's forgiven 10%, and then you have to live in the house for 10 years in order to not have to pay any of the grant back. And I wanted to ask you, Bonnie, do you know if people can still use the city grant with the FHA? Because basically, if you got the city grant, that would be like your 3%. Do the new FHA requirements still allow that, or are they going to phase that out too?
I think that is being phased out, but I'm not completely sure. I'm not sure. What they're trying to do is get the homeowners to have a little bit of investment in the property is the goal. So if they allowed the city grant money, it would be similar to the Nehemiah or the AmeriDream program. But I have not read anything on that, so I can't say for sure.
Okay, well then the city grant, I guess, would really only be for people who are going to put at least 5% down then?
Well, I mean, you could take the city grant money in addition to your 3% down payment.
Oh, okay.
And the city grant money, I believe, is up to $3,500, but it can't be your total down payment, I don't think.
I see. So you could get, well, I know it can be part of your down payment. So you could put down 3%, and then the city's grant could be an additional down payment.
Right. Our closing cost.
Closing costs. Yeah, that'd be good. All right.
So the 3% of the buyer's own money, that's kind of a fail-safe approach?
Yes.
Because whatever
With
else happens, if they got the
conventional.
3%, then they're in the game.
Yes, that's the plan. And 3% isn't a huge amount, but at least they have put something forth. Yes.
Yeah, I'm in agreement with it. I just know that as a realtor, a lot of times people don't have, they don't have 3%. So they're going to have to wait. They're going to have to save up some more money.
Yeah, it was, you know, a couple years ago when we were doing all of those 100% loans, it was cheaper for them to get into a house than to rent. And it really expanded home ownership, which was a good thing, and most of the people were good. But there were enough of a percentage that have now gotten into trouble over that, and so it's caused the tightening up for everybody. You'll see 100% back, but maybe not in my career span.
Well, do those foreclosures for people that shouldn't have bought homes, do they put more people at risk when the housing values go down in an area?
Oh, sure. You know, if your house is foreclosed on and the bank sells it for a $40,000 loss and you live next door, when you get ready to sell your house, there's a comp. You know, that house sold for this, and it's the same house. So if you're surrounded by a few foreclosures, it is going to affect the value of your house, certainly. Now, we haven't had a huge problem with that in our area, fortunately. But boy, on the coast, it's been a bit of a mess.
All right. Well, was there anything else you wanted to add?
Oh, there's one more thing
Okay.
one more gift for homeowners in this housing rescue bill. They're increasing the property tax deduction for all homeowners. The property tax amount is added to the standard deduction. So if you don't ordinarily itemize, you don't need to. You can still deduct your property taxes.
Well, and Steve, they have increased the loan amounts that Fannie and Freddie, wasn't that in this bill that they did that?
Yes, they increased the maximum loan amount in high-cost areas to $625,000. I believe it used to be $475,000.
Well, it's $417,000 in this area, but the high-cost areas, it's
like Los Angeles,
right?
And Las Vegas.
Yeah.
Well, how do they define which areas are the high-cost areas?
Price of homes.
So they just average them?
The average price of a home in a market.
Of a home,
yeah.
Okay.
Yeah, I'd hate to think of somebody needing an FHA loan to live in on the coast or in Beverly Hills.
They might.
I guess it could be, you know.
Yeah.
3% down on a $6 million house.
Yeah.
All right. Well, thanks, guys. I appreciate it.
Thank you, Erin.
You're welcome.
And if you have any topic you'd like for me to cover on my show, please email me at thetruthaboutrealestate@gmail.com. Thanks for watching.